So, advanced combos. Let's dive in. Disclaimers. Here they are. Be careful. We're not advisors. We're not brokers. We don't give guidance. We don't give recommendations. Yada, yada. Markets in a bit of a struggle. What is our agenda today? Strategies that might become useful to us. Number one, a quick intro into advanced combination spreads. What makes them advanced? We're adding even more legs. So far, we've done 2 legs. Remember our building blocks. We start off as buyers. Then we work as sellers. Then we can combine them and we become 2-legged spreads. And we work on vertical spreads, which are directional. We work on horizontal or calendar spreads, which are time spreads. And then we work on diagonal spreads, which are a little bit of both. They each have slightly different mechanisms and behaviors around the core option variables: price, time, and volatility. Now what? Now we add a 3rd leg or even 2 more to have 4 legs. So that's what makes these a little bit different. That's why I differentiate them as the advanced combination spreads. Then we'll talk about exploring butterflies. Butterfly spreads is one. And iron condors. Now, here's what's interesting is that you can have an iron butterfly and you could have a standard condor. We tend to do long butterflies and short condors, meaning it's a debit on the butterfly and a credit on the condor. We'll see why. I'm going to focus more on butterflies. And I might even, and this is definitely something I might not have time to do it today in the theoretical building of a butterfly in the pricing model, do a broken wing butterfly. But we definitely will do that on Tuesday when we do a working session. So we'll do a working session on this. And then, let's see, working session. And then we have, that's on Tuesday. And then on Thursday, we have the Greeks of next week. And then next Tuesday is our final working session. Okay. We're coming to the tail end of this thing. Talk butterflies. This is part 1 and 2. We'll talk iron condors, some advantages, some disadvantages. We'll talk about pitfalls to avoid most of today's more theoretical. But these are great trades. I used to do more iron condors. Now I do more butterflies. I will tell you why. Early preview. An iron condor is just like one big wide, like boom, set up the goalpost and say, all right, there's pretty good probability the ball is going to head this way through this range. We give it some time. It's pretty stable, right? And that becomes a trade. Interestingly, Thinkorswim, which now is a remnant, it's a platform that is a part of Schwab. It used to be a platform that was a part of Ameritrade. Oh my God, I almost couldn't think of the previous broker. Ameritrade. And before that, it was its own broker. And at that time, it was heavy on education. And it was interesting. They used to actually have a program where people would move to Chicago and live there for 6 months, coming into the Thinkorswim offices every day. And it was all about working iron condors every month. Just a big right? To where you're making like, people would be doing tons of contracts, making 5, 6, 7 grand a month. And that was the income, just boom, every time, boom, boom. And they would defend them with calendars and butterflies as defense. And I was trading it. And then one time after I did similar, not exactly, but similar, I took my results with all my hedges, all the butterflies and all the calendars. And I'm like, wait a second, I lost money on all that. Like I was better off just putting these calendars or putting these iron condors on. And at that point, I really started to look at, well, what would I do with them then? And I started to refine my strategies. So we'll talk about, because there's a lot of different ways that you can have. Hey, what role does this play? You're selling premium, so in that regard, probability is on your side. Right? We from a probability standpoint, it's always better to be a seller than a buyer. In this case, it's a matter of, do I start with one big wide range, or do I start with one pretty wide range that if it breaks out of it to the upside, I can put another trade on. If it breaks out of it to the downside, I can put another trade on. So I could adapt it either way. That way I don't get it wrong. Or if it doesn't move anywhere, I don't have to do anything at all. And that's really a similar thought process to how I do calendar spreads. Put it on, let it sit. If it sits long enough, take it off. Take your money, put another one on the next week out. If it requires you to do some kind of a defense, you can extend the trade, right? That's what we're talking about with these last couple of strategies: diagonals, calendars, and here with butterflies and iron condors. This is not speculative options where you're like, I'm buying a call and it's all or nothing. And right, this is a much different mindset now, where we come in and we manage it using the Greek profile to understand the deltas and the thetas and the vegas, and really make sure that we're aligning what our option execution looks like relative to our market posture. So let's get into it. May 10th. You're still with Ameritrade. Okay. I thought for some reason everybody had gone through that. Interesting. Let's hit it. Intro to advanced combination spreads. This is 3-legged and 4-legged spreads. So we kind of did this already, a quick recap of options trading, our building blocks. But we know that with options, there's always buying and selling that give rights, that give seller or buyers or the holders the right, but not the obligation to buy or sell. We know that the sellers are obligated. It creates the system around exercising and random assignment. Right? We should have real strong grasp of calls and puts and strike prices and expiration dates. We should have a real strong sense of buying and selling. We should, right? All of those building blocks, understanding what we did for the 2-legged spreads, all of that is what leads us here now to this place and the need for advanced option strategies. If you're selling, there's an obligation. Absolutely. If you buy, you have rights. If you sell, you have obligations. 100%. Right? And these are contractual. Now, as a seller, can I eliminate those obligations? Yes. Close the contract. You sold it to open. How do you close it? You do the opposite action. You buy it to close. Touch up. Does my slide not say that? It gives the holder the right. The holder the right, but not the obligation. We are extending that logically to then the sellers do have the obligation, but the holder or the buyer, he does not. She does not. Only rights. Okay. Need for advanced strategies, market complexity like this. What do you do when you're in what you know is overall a bullish market, but we may go into a correction period? It could take a month or two, right? It could take a month or two. And what's happened? Volatility has inflated to some extent. So the complexity of market conditions now, I'll tell you right now, some people might not recognize that because they don't go into the level of weekly detail we do with the objective of comprehensively understanding market conditions. That's why we want to do it, is so we can do something like this. It's some of the subtleties, but we recognize that the market has indeed, it looks like we're headed to our third straight week of decline. It's not a huge drop, but it's enough that we're now like, okay, we're ready to go the other way, right? It's not that I'm like, I've said this before. I'm going to reiterate. We don't wait until we get negative on our market posture and be like, oh, now we can trade to the downside. We're ready. Like I would imagine at this point, you've cleaned up a lot of bullishness. You're kind of waiting. However, there's still going to be some bullish signals potentially. So it's like, how do I trade those? I don't want to buy calls. The calls are inflated right now. Can't just buy inflated calls. Of course not. What do I want to do? Well, I'd like to put a trade on. Let me talk this through, and then let's see if we all end up in the same place. A couple of things I'm thinking. Number one, if I trade directionally, so in our watch list, we have a number of bullish trades, bullish stocks still look strong, that are in strong groups. They look ready to go, but they've gotten swolled up volatility. The IV has pumped, meaning the options are more expensive. So whatever we do, we have to be more careful. What if on a trade like that, I thought, you know what, I'm ready for it to go directionally, but if it doesn't, what if it just grinds to a halt? It's April 18th. We were hoping, and our posture was pointing to catching that April cycle where it's a nice, strong, bullish month. We didn't get it. It doesn't look like we're going to get it. Great, adapt. Now we adapt. So now we switch to a different, now what? Right? And so we say, well, it could still, there's enough bullishness. Be water, my friend. Bob said it. I love it. Be water, my friend. We adapt. Now what? Okay, so we're ready to trade potentially bullishly, but what if it grinds sideways because sell in May and go away? Because from a cyclical standpoint, May and June tend to go sideways overall in the market. So not only do I want to have that preparation, but I also think to myself, I want to be ready to trade the market sideways. So if you remember, when we were talking about calendars, my preference was index ETFs, primarily SPY, secondarily QQQ, IWM, DIA. That's how I'm going to do calendar spreads. I'm going to mostly do the diamonds or the spiders, and I'm going to sprinkle in the others. Same thing here. We're now thinking, well, I don't know that I'm going to do calendars. Why not? Because the VIX is up around 18 now, right? The VIX is inflated. We said we can't put that ourselves at that risk. So what would I do instead? Well, for the first scenario where I have a bullish stock that has inflated volatility, I want to do a broken wing butterfly. We are going to build those on Tuesday in our working session. For the second, I want to build either a standard butterfly with the ability and the readiness to build a second butterfly on either side, whether it goes up a little or down a little, up too much or down too much. I'm going to extend the trade by most likely putting another butterfly on. I do actually have the ability that if all of a sudden it made a big move to the upside and the volatility dropped out, I could actually add a calendar to a butterfly. They work well together. They're like kissing cousins, so to speak. Right? The only difference is the Vega. Other than that, they're like, yeah, let's hang out, you know? So it's the alternative, this neutral trade to a iron condor. And a lot of people love iron condors. They just put, right, you put one on one side, you have, it's basically, here's what it is. It's two credit spreads. That's what an iron condor is. It's a bull call spread, or excuse me, a bull put spread way down below where we are now, and a bear call spread way above where we are right now. And you want it to stay above one and below another. And basically that means you want it to stay in the middle. Iron in this case, and I that's a great trivia stumper, Press. Iron in this case refers to the fact that we are net credit versus a standard. So I just described an iron condor as two credit spreads. A standard condor is, so in that case, it would be half calls and half puts. A bull put spread on one side, a bear call on the other, half calls, half puts. A standard condor would be a bull call spread on the downside and a bear call spread on the upside. So it's all calls. Are they statistically that different? No. People love iron condors. Why? Because it's two credits. And they love the concept of two credits. But remember, we do not get fooled or distracted by just the fact that there's two credits. Now, condor, I'm not sure where the terminology for butterfly and condor. I'm thinking, condor is bigger. I'll tell you one thing, and you'll remember this as we move into, well, let's just advance the slide. Market complexities, managing risk in more complex markets. Yeah, right. 2004, 2005, a lot of sideways. It was really hard for a lot of people to make money. Not savvy options traders. That's what we're looking for. Remember, there's an op for that, right? An option strategy. Okay, here we go. I know, terrible joke. It was a combination of me and Bob together. Exploring butterfly spreads and iron condors. So what is a butterfly spread? A neutral strategy that combines a bull spread and a bear spread. This is the easiest way I know to just sort of visually teach this concept, because you're starting to get comfortable with risk profiles. So if I have a bullish spread, right? So if I have a bull call, it's going to go like this, and then it goes up, and then it goes like this, right? I have a max loss and I have a max gain, and that's a bull call. Now imagine if I take a bear call spread and I put it this way, like this, and it goes up, and then it goes this way. And what happens is these actually cancel out. And it leaves you with, if it goes to the top of the bull call, I make money there. If it goes to the bottom of the bear call, I make money there. So where do I want it to go? Right in the middle. And if we put in a break-even line like this, that is going to give you the risk profile of a butterfly. Right now, it's a bull call combined with a bear call. What's another way to remember that? This is the way I learned to remember a butterfly. You buy the wings, you sell the guts. Buy the wings and you sell the guts. So these are your wings, here and here, and your guts are in the middle. So I buy one, sell one. That is the bull call. Then I sell one, buy one. That is the bear call. Stack it on top. Boom, butterfly. Now, what if I were to push this one this way a little bit and this one this way a little bit? Well, I'm no longer going to have a point, right? Now, what I'm going to have is I have a bull call spread here, and then I have a bear call spread here, and they connect. And what does that look like? An iron Condor. Just both of these can be split into two basic trades. And what do they create? They create our desire for it to stay as close to the middle as possible. Now, obviously, the probability with this one having this broad flat top is you have higher probability of it staying in this range. You have higher probability, but you get less for it. So that is what we're building here. When we say a butterfly, we're just taking two spreads, putting them together, and we're creating a new structure. It's just a matter of understanding what is our objective that would lead us to wanting to make that trade. Okay, I have two things. I have number one, if I am thinking that volatility is high. Number two, I am neutral or neutral to slightly directional. This is going to give me those types of strategies. So let's talk through that now. 3 strikes, creating a profit zone between the upper and the lower levels. That creates a triangle, remember, for our risk profile. Iron Condor creates more of a plateau. So what's the difference then? This one is a higher probability, but remember, if I get in this one and it moves too far, I'm in a lot of trouble. Whereas if I get in this one, I can let it get out to this area here or this area here and wait to see, does it pop back in? Because if I put another butterfly like this, then they sort of meet in the middle and they actually start to behave very much like this structure. So it's almost like the butterfly allows us to leg in and extend our probability of capturing the right zone. Make sense? If not, let me know. Iron Condor. So an Iron Condor is two. So when we're doing the butterfly, we're doing a debit and a credit combined. And this is usually going to end up being a debit strategy here, right? So long butterfly, debit butterfly. This one down here is a credit and a credit. 2 credits. That's one of the key differences. You have 4 different strike prices, which creates the range for whoops. Now, here's the thing. This slide, Bob, is a little misleading. It's technically right, but it's a little misleading. We're designing to capitalize on low volatility, not low implied volatility, low price. I'm going to write that in so we remember. Price volatility. But we're actually also looking to capitalize on high what? IV. High IV, right? That's the VIX. When the volatility is higher and options are more expensive, this makes sense when we think the market has a chance of grinding on sideways. And you might be thinking, that sounds like a pretty specific market. Well, what do we expect in May, in June? Sideways. What's happened to our volatility? It's gone up. There you go. Right? So this is moving us into exactly the right type of volatility for these types of strategies right now. So I'll tell you that if you're an option buyer, if you know some people who are like, oh, I always buy options, they are struggling. Option buyers are struggling. Most of the trades we've done recently, even if it was an alert, was off of a spread. Why? Because the spread hedges us, it protects us. I'm not getting beat up on time decay and all these other things that are happening. Buying options is a tough racket right now. IV means more price. IV means actually press. IV is implied volatility. That is an option indicator. So not necessarily price. It says that options. Now that doesn't mean that it's moving a lot. It means that there's higher expectations that it will move a lot. That doesn't mean it's going to. I expect it to actually kind of grind out sideways in June and July as we wait to get more signs of the Fed getting ready to get back in favor. How is implied volatility calculated? There is a white paper from the VIX, from the CBOE, the Chicago Board of Options Exchange, about the VIX. The VIX is kind of the gold standard. Go take a look. Essentially, it boils down to looking at out of the money options over multiple time frames now versus a historical representation of those levels to see are we higher or lower relative to the range. So essentially, implied volatility is trying to tell us how are the options priced now relative to what people have been willing to pay for them before. So we can essentially recognize cheap or expensive. Excuse me, give me a second. Press said he read the paper and gave up. It's a lot. It's heady. There's a lot of math in there for sure. A lot of fintech in there for sure. Okay, let's keep going. Onward and upward. Butterfly spreads part 1. So what are we doing? I'm going to use either calls or puts. I tend to use puts for my calendar spreads and calls for my butterfly spreads. Why? Because there's a chance that they may overlap, and I don't ever want them to crisscross each other, so I make sure they're different types. And because I have found that there's just a very slight edge to those two different levels based on the way that I trade them. That's not always going to be the case. So I'm not going to say, oh, butterfly is always better calls, and that's not it. I'm just telling you the way that I tend to do it. So what are we doing here? I'm gonna pop in because the slides get to be a little much. Let's actually build a trade here. So let's go in. There's a butterfly right there. Speaking of, let's just sweet chicken. Okay. Yeah. Amazon. Why did we put this trade on Amazon? Well, let's go take a look at a chart. Yeah, this is what we said here. You can see even going into late March, we were still making new highs. The sellers weren't doing anything. And then all of a sudden, right through here, you can see we just sort of fell. And even this week, we've got one more volume day. I think volume's going to go negative, right? Now, we're still only sitting around a 5%. 4.5%, 5% consolidation, but it's increasingly now as our market postures down for the third straight week. Now's where I start to think, okay, you know what? If it's gonna be the 10%, right, where we drop down into this like range down here, it typically is gonna be a double dip. We come down, stabilize, we come up, and this is that bullish trap where everyone's like, oh, we're good. And we're like, whoa, are you sure? And that's where things can hit that second dip. And we end up with that 10%. Go back, look in August, September, October, very, very similar thing. So yeah, our guard is up. Yeah, our guard is up. Let's go to Amazon. Sorry, it's always worth talking about conditions when we're all together. Amazon, apologies today. I popped in and then I went to get a coffee and Sandy popped in. And by the time no one was in there. So I'm like, oh, ended up, letting the dog out. And I came back and no one was there. Sandy and I missed each other. Here's what I'm going to tell you. We will make this will be an integral part of your trading, this Discord community where you're constantly just like, oh, it's giving you notifications. We will make it happen. Okay. Now what do we have here? Amazon. Now, you can see here, like, you're like, it's bullish, Scott. Look, it's on the upside. Well, it is, but it's also, if you notice, from this gap right here, that's almost 3 months ago. We're only up 8 points. That's about 2%. And so it's not really moving all that well. So we said, hey, what if we put this trade on something like this? But we also said, if I wanted to still make it directional. So this is the butterfly. You buy the wings. Let's show that. So you buy here and here. That's the outside. So there's 5 of those and 5 of those. 5 of these, 170s, 5 of these 190s. And then these both connect to selling in the middle here. Where? At 180, right? I think it's 180. Yes, 180. That's the middle. Buy the wing, sell the guts. You can see that we have a nice little structure to the upside. If it does move too far to the outside, we have the ability to adapt. But this is a neutral trade where I say it stays below between 172 and 188. Between 172, whoops, and 188. So what did I just do there? I have no idea what I just did there. Okay. Here is 172 down here. And 188 is up here. That's the range. So yeah, that's very neutral. But you might say, Scott, it feels like it could maybe keep going higher and get up towards this 190, 192, 193 area. And if it gets up into that 190, 192, 193 area, I have no idea what I did here. So weird. Okay. If I get up here to 192, 193, it's not a big loss, but I start losing money up there. What can I do? I can break the wing. I take 190, and instead of having 10 points and 10 points, I have 10 points and 5 points. Right? 10 points and 5 points. And now I have a broken wing. This poor butterfly, he can't fly. All he can do is make money bullishly. You can see that now, if it gets up to 192, 193, yeah, I'm in a good place. It moves a lot slower now, but I have guaranteed upside money. So if you're like, yeah, this thing could really pop, this is a better strategy. You'll see it still behaves like a butterfly in the middle, which means that if it just grinds sideways for a while, right, and time's ticking, you can see that if it's just sitting in the middle here, no problem. I can just wait for it. And if it ultimately stays in the middle, this behaves like a butterfly. And I'm going to make really good profits if it doesn't move. But if it moves up here to 192, 193, still good profit. So here's what this means to us. This means that this is a directional higher probability trade, right? I'm in here as long as it stays above this level by expiration. So that means it can go up and I make money. It can go slightly up and I make money. It can go sideways and I make money. It can even go down a little and I still make money. So probability of success is significantly higher, right? This is not a trade where I'm like, oh, is it going to move in the next 2 or 3 days? Look at this thing. This moves steady. This is slow and steady. Slow and steady, but look where the vol is. The implied volatility is really high. If you put a trade on for slow and steady and you buy an option that's expensive and it's slow and steady, that's going to kill you in time decay. We can't do that. You cannot do that. So that's why a strategy like this, in any directional trade in these types of consolidations or corrections and immediately coming out of the corrections. Press said, sell the guts means the profit is in the middle. Sell the guts means, yeah, that you're selling this, which creates that peak, right? It creates the peak. So Bob says right now he uses standard, which is equidistant. And this looks, you'll notice, this looks a lot like a calendar, right? It's this triangular shape, time decay. And it is. If you look at the Greeks here, there we go. What's my delta? What's my delta? My delta is neutral. Delta neutral. What's my theta? Positive. If we did a calendar, what's my vega? Positive. So those are good for neutral trades to make money from time decay in a low volatility market. These are good to make money from neutral trades in a higher volatility market where you're concerned about it possibly coming down. And that's what you have here. Okay, butterflies. I know it's a lot. It's a lot, but it's worth it. And we'll have a lot of fun with these next time when we, but not really high, right? Right. Okay. Time frame. Honestly, I would start anywhere at 3 weeks, 3 to 5 weeks, just like we do. I mean, and I would expect to be in it for about the same amount of time that I would expect to be in a calendar spread. When I do 3 weeks, I'm only going to be in there for 1 to 2. If I do 5 weeks, I might be in there for, 2.5, 3 weeks. But that's it. Now, when I establish the position, I don't establish the position and then prepare to capitulate. I establish the position and then I prepare for how am I going to adapt this trade if it goes a little bit against me to the upside or to the downside. I'm ready to defend it. I'm ready to extend it. When we're dealing with these types of trades, there's a very good chance for markets to just sort of grind it out. So all we have to do is kind of catch that. And when we catch it and it grinds, we just start eking out theta profits, which is just a whole different style of trading, which is interesting, right? Because it's not a high volatility market like you would have in a bearish market. When we hit that kind of high volatility, I would expect us to do some day trading because things are 30, 35% implied volatility and you're getting 3-4% moves per day and everything else is hard. So you're just trying to hold on for dear life. Defend or extend to follow the trend. Exactly. Okay, part 2. Analyzing market conditions, right? We're talking about that a little bit, which is making sure that we are in the right type of volatility environment, the right type of price action environment. Those things are definitely important for us to get right. So there you go. Okay, iron condors. So remember with an iron condor, it's the same thought process. When you look at, so let's go back to that. Let's go back to this. Now I'm gonna do a comparative iron condor. So let's go to a iron condor and let's sell. So let's see here. Let's go 160. I think we need to go a little higher. 185 by 180 risk profile. Oh, there is our there's our plateau, right? Now you can see here, let's see, I can definitely make this wider. Where did I want the butterfly? Closer to the 180 level. So let's even make this, let's move this up 1 and this up 1. So I'm going to go 185, 190, and then I'm going to go 170, 175. So now I've moved it. And here's the thing, right? Is if I want to give this higher probability, what do? I can just take it and I can go to, I can take this to 190 and this to 195. And then I can take this back to 170 and this back to 165. And you'll notice now I've got this range. It's from 170 to 190. And I have max in between. Now I'm still in trouble if I get out to 192.5. Or if I get down here, right? So it's a very similar. What's my delta? Neutral. What's my theta? Positive. What's my vega? Negative. So what's the difference then? The core difference between an iron condor and a butterfly. flexibility, right? Flexibility. This doesn't have a lot of flexibility. I've got this big, wide structure. I can't just like pick it up and move it. You don't put a whole nother iron condor on because it's this big, wide behemoth of a thing for contracts, right? So if I put it on and all of a sudden it moves up here to like 195, let's say. So let's move this guy here up to 195. And this thing's under some pressure. It's under some heat. You don't just have easy money trades, right? So here I'm in trouble. What would I do here? You can see I'm down, but it's actually pretty manageable out here still. And if the volatility went high enough, I could put on a calendar. But if the volatility is still high, I could actually take this and I can analyze this trade and I could move everything up 15 points, let's say. Let's go 185. 195. 205. 'Now look, right? Now I have this double butterfly structure. And now you can see I'm extended all the way out here to like 200, 201. I can't do that with this trade. Oops, I'm stuck. I can't get out here by 201. This thing is down $1,000 and getting really dicey. But if I have this on, I can say, oh, I'm extending my trade. And now you'll notice that as long as it doesn't, if it hits some resistance and bounces back, this is all about time decay, remember, right? You can see what happens. I've got this. Look at that time. All it has to do is what? Stay between 173, 201. Are there markets when we expect things to just kind of grind it out? Absolutely. If you think it's going to be straight sideways, which I'm more inclined to do with markets than individual stocks, then I tend to do standard butterflies with the ability to adjust one. If I'm more directional, then I end up thinking to myself, let's break the wing and give ourselves a directional component. So if you're following the line of time and price goes buy, sell, buy on a butterfly. Yes. Yes. And the cells are on top of each other. So butterfly versus iron condor, these are advanced combinations. Oh, I have the wrong slide in here. This is the one I want to have. Sorry, I was supposed to delete that. That was not relevant. Pretend you didn't see that. Iron condors. We're looking for range-bound market conditions. We're looking for implied volatility to be higher. We know that the options are more expensive. Like anything else, we're constantly evaluating profit loss, making sure that our reward to risk makes sense. If you do it an iron condor and it breaks out, you either have to take the loss on that and then wait for your other contract to make max gain, and then you're going to take it a little bit on the chin, right? So ready to adjust, roll, or close the trade. All right. Advantages and disadvantages. So butterflies and iron condors offer limited risk exposure, right? There is a defined maximum loss. This allows us to get into these trades with predetermined levels of risk and expectations of profit. These are income generation. We would consider this trading options as income strategies. Even though the butterfly is a debit, we are trading for time decay. So I do consider those to be income more than speculative. Speculative is more directional. So they definitely help us when we're theta positive. Any luck? Yes, we will talk about that slide, Bob. and I will post it. We will talk. Bob said, any luck finding the slide that shows all the types, when to use them? I wonder if I could even dig it up as I'm going through this final slide, and we're getting ready for some questions. It's got to be in here somewhere. What was that slide called? I can't remember. I am gonna have to find. I'm gonna have to. What did I name it? I don't know. Some clever name back when I made the slide. Okay. What are the disadvantages? Limited profit, obviously, right? If we're gonna increase our probability, we're certainly gonna limit the amount of money that we can make. And these are more complex. There's a learning curve here. You're not going to just be like, oh, yeah, I get it. Oh, that's perfect. I know what I'm doing. Yeah, we're going to want to put on some paper trades, get some familiarity with these. They're manageable trades. I actually think they're easier to manage. They're just more complex to initiate, to understand, to kind of build them. So, yes, should you paper trade these? 100% you should. No better time to start than now. Dive in, start making some paper trades. Okay, few pitfalls. Let's not ever ignore market conditions in adapting to implied volatility. Let's make sure that we're always ready to recognize trend reversals. If the market catches, we're talking neutral strategies. If the market catches some fire up or down, it's going to put us in some stress, and we have to be ready for that. We don't want to react. Proactively be ready for that. Neglecting risk management. It's very easy to put too many of these on. However, this is why paper trading can help, because you can also do too few. You're like, oh, you end up with 3 of these, and it's like you do great, and then you have this small little credit from it. This is a very different strategy. So you want a paper trade to help find what the right position size for you will be. Make sure that you control your position size. Lastly, this one is still important. It's gotten better, though. Transaction costs. We're still paying per contract. So it used to be really, really important to find, like, where do I get the best per contract rate? And nowadays, you typically can get yourself 50 to 75 cents a contract. I mean, it still matters, though. So make sure that if you're doing a lot of contracts, you can control your transaction costs. Okay, quick summary. So get your questions ready. You really want to, we've been building towards this. All of these strategies are great and they have a place. These included, especially as we approach what could be some sideways yet higher volatility conditions. These are perfect for those types of situations. They benefit from limited risk and income, but there's a learning curve. They can feel safe, and then all of a sudden you find it, you're like, oh, everything's great. Then you're like, oh my gosh, where am I? This is crazy. Do a lot of research, do a lot of paper trading. Make sure that you are ready to adapt if conditions change. Yada, yada, yada. There it is. Like always, there's slides and there's what is it and how does it work? And then there's let's build some and really see. I think that the Amazon was a good demonstration. I feel like that was maybe better suited for the either for a slightly biased butterfly ready to adapt if it went bullish again, or a broken wing butterfly. I think either of those makes sense for that. When we talk on Tuesday and we do a working session, I'll definitely do some standard butterflies on SPY and maybe QQQ or DIA. And then also we'll look at broken wing butterflies as directional trades on anything from our watch list where we're like, hey, this is still actually bullish and we may still catch this bounce. So if you remember, we were looking for a bounce in October and it didn't come. And then all of a sudden it came late and we're like, woo, here we go. So there we go. Oh, look at that. Sandy's organized. She puts stuff in the right place. She put that slide in. I'm not able to like download that. For some, well, it's not letting me. Oh, there we go. Copy image, save image. Yeah, you can save it. But that's just that nice, quick little breakdown. So, all right. What's next? Oh, here we go. Love it. Press said his 2 books came today. Technical Analysis of the Financial Markets by John Murphy. Just everyone should have that. That should be a constant, close companion for anything technical analysis. It's just a comprehensive one. Fooled by Randomness is just a really good read. It'll dive you into some psychology. Love it. Love it, Press. Keep us posted on that. So yeah, Sandy did post that resource for you. We're going to talk about that in more detail. You'll notice that I don't do what a lot of people do where I'm like low volatility mid. It's low or not low for me, right? It's cheap or not cheap. Those are the only options. And I think you'll find easier to build trades that way. I used to try to catch it where it's like, oh, it's mid, but it's going up, or it's mid and it's coming down. Nah, it's not worth it. Don't bother. There's no statistical benefit to doing that. I promise. So I'll save you some time and just keep you in those 2 categories. Any other questions for today? I tell you what, guys, we hit it hard. We expanded this to 2 months, and even then it's like there's a lot to go through. But I'll tell you where it really, I feel, comes together, but I want to hear from you, is the working sessions, right? The working sessions when we build it, we move it, we play with it, we kick it a little bit, right? We poke it and prod it to see what happens, and what if this happens, and what if it goes there, and what will I do? And that really, I'll tell you, playing with the model to do those types of what if scenarios in order to understand how the options behave as conditions change is just absolutely so helpful. All right. Thank you, Sandy. I appreciate your guys' patience with the intro snafu. I still don't. I shut it down, started, mic worked. I couldn't find a setting that said, hey, play some swanky elevator music rather than turn your microphone on. There wasn't a setting for that. So I'm like, I don't know what the hell to look for here. Anyways. Yeah. Where did she find? I think I had posted that a long time back, and Sandy's just amazing at like putting things into a folder when she gets it, and then she's like, oh, it's right here. I'm like, yeah. Anyway. Oh, okay. Phil said I had a small black box overlaying my screen. I could still see, but had to swipe to the side periodically. I think is that where he just needed to maximize the screen, guys? Is that what was going on there? Let me know. So, yeah. All right. Well, let me know next time. Yeah, Sandy is amazing. Next time, what are we talking about? Not implied volatility in the Greeks. I'm lying to you there. That's not what we're talking about. We're actually going to do a working session on mostly butterflies, couple of broken wing variations. I don't think I'm going to build an iron condor. If someone here is in attendance and says, Scott, will you please construct an Iron Condor live just so I can, get a sense of like, what could I do, or right? Then yes, I will make sure to do at least one. Otherwise, we'll focus just like we didn't do any kind of like, we only did bullish diagonal spreads. We're only going to do butterflies. That's the rule. The versatility of butterflies is amazing. There you go. It's good to see everybody. I appreciate you being, I would say that I'm a little late, but we started late, so we're really more like right on time. Tomorrow morning, real quickly, I'm going to pull this over and you're going to see yourselves. I'm going to go here to the events. When you go to your events and you come to the weekly, oh, wait a second. Yes. We've already had the other one. The weekly the Friday market open. This is not, we tried one this morning that was just a chat one. This is the, Graylin. Oh my God, it's so good to see you in. Amazing. So glad you're in. I hope you're finding it easy to navigate around. So tomorrow, it won't be on the stage. It will be, and you can see here, this tells you where it is. And if you come to the calendar when the event is happening, it will actually take you to the right place. But this is at Market Watch Meetups. And Market Watch Meetups is right here. This is one of these voice channels. I can't go there now because I'll disconnect myself from the stage. But you'll go to Market Watch Meetups, and hopefully at least 2 or 3 of you there will be there to have a quick chat about market open and conditions as we finish the end of the week. It will start at 9:15 Eastern time, 15 before the market open. I will turn it on. I don't think that I'm going to be able to participate, but we'll see if we'll see who else we can get to come. But I will be able to many times, but just won't be able to tomorrow. All right. Well, thanks. It's good to see everybody. So tomorrow, what do we have? Let's go back to the calendar, right? We have a calendar, so use it. We go back to the calendar. If you don't make it to the Friday market open, which occurs in the Market Watch Meetups, then tomorrow at 1:15, I don't think anyone ever showed up in Zoom. All Zoom did today was record this for me so I could post it. Tomorrow at 1:15 my time. This is Mountain, but it will tell you your time. This is a feature that Sandy loves because it takes care of all time conversions for us. So 3:15 Eastern weekly market wrap. Where does that occur? On the Market Watch stage, which is where we are now. I will start a little early to make sure that if we have a snafu with the audio, I can get it cleaned up pretty quickly and move into the meeting. Okay, questions, comments, or concerns? Let's make sure that we really utilize this and start utilizing each other. Work on your trading plan, post a comment or a question. Working on an option strategy, post a comment or a question. Talking just trading in general, right? We'll have a lot of different discussions going simultaneously, and the ability to keep interacting with each other and engaging as a community. Woo! That's a lot. I'm tired. I'm sure you guys are too. Have a wonderful rest of your night. I'll see you tomorrow. And as always, happy trading.